You know what's funny? Traders spend hours analyzing charts, hours looking for the perfect setup, hours refining their entries, but almost none of them question the one thing that quietly controls every indicator on their screen: the settings. That's exactly where the hidden danger lies. Because using the wrong indicator settings, or worse, using the default factory settings in every market, is one of the most destructive mistakes a trader can make. Today, I'm exposing the silent settings trap. Welcome back to the channel. If you've ever wondered why your indicator signals look fantastic in one chart, but fail miserably on another, or why your favorite indicator feels broken in certain conditions, this video will open your eyes. Because today, we're not talking about indicators themselves, we're talking about the settings inside them, the numbers that most traders leave untouched. 9, 2, 6, 1, 2, 5, 0, 2, 0, 0, 100. You've seen these numbers 100 times. But here's the truth. These numbers were never designed for your strategy, your time frame, your market condition, your style. They're just defaults, and blindly trusting them. Most traders treat indicator settings like magical formulas. RSI 14 must be the best. MACD 12, 26, 9 works everywhere. Bollinger Band's 20 period is universal. ATR 14 works for every stop loss. Moving averages 50 and 200 are holy. But the painful truth is, these settings were never meant to be universal. They were simply chosen decades ago as good enough for general usage. Markets have evolved. Volatility has changed. Trading volume, algorithms, structure, everything is different. Yet, traders still use the same settings that were created when charts were drawn on paper. And indicators depend on period length, which controls sensitivity responsiveness, smoothness, lag noise filtration. When you take one fixed setting and use it across different markets, you guarantee inconsistency. Let's break it down with real logic. Different markets behave differently. Some move fast, some move slow, some spike, some grind, some range, some trend smoothly, but indicator settings remain fixed. That's like using the same shoe size for every person. It simply doesn't work. Let's imagine a trader is using RSI with a 14 period setting. In a slow market, RSI moves lazily. Signals come late, trend entries become too delayed, reversals pass by unnoticed. In a volatile market, RSI becomes hyperactive. It triggers false overbought / oversold signals. It flips rapidly. Noise becomes signal. The indicator didn't fail. The setting failed. The market condition. This is where beginners get crushed. Let's say you use a 20 period Bollinger Band. On a 1 minute chart, 20 candles represent seconds of data, total chaos. On a daily chart, 20 candles represent almost a month of data. Very, very stable. So the same setting represents micro volatility on lower time frames, macro structure on higher time frames, and somehow traders expect the indicator to behave identically. This is the settings trap again. Different strategies require different indicator behavior. Trend strategies need smoother signals. Reversal strategies need faster signals. Breakout strategies need wider volatility bands. Range strategies need tighter bands. But default settings don't adapt to strategies. They are not designed for any particular use case. Using standard settings for a reversal strategy is like using a marathon shoe to run a 100-meter sprint. Here's the interesting part. Why do traders stick to default settings? Because defaults feel safe. They feel standard. They give the illusion of correctness. It's the same reason people don't change TV picture settings, phone brightness defaults, or factory audio presets. Human psychology prefers familiarity over optimization. But in trading, that comfort is expensive. And no, this does not mean constantly changing your indicator every hour. It simply means adapting the settings to your market environment. Here's the practical framework. 1. High volatility beats longer settings because fast markets generate noise. Longer settings help smooth that noise. Example, RSI 20 behaves better in spikes than RSI 14. 2. Low volatility beats shorter settings. Slow markets need more sensitivity, otherwise your signals come way too late. Example, fast moving average like 10 period works better in a quiet market than 20. 3. Trend market leaves smooth settings. Use higher periods to avoid whipsaws. 4. Range market leaves faster settings. You need quicker signals for tight price action. 5. Multi-timeframe check. Always compare the indicator's behavior on lower time frame, base time frame, higher time frame. If settings produce consistent behavior, you're good. If not, add. Here's where your trading transforms. Open your chart, pick any indicator. Now test it with period 7, period 14, period 21. Suddenly, you'll see 3 completely different behaviors. The question becomes, which behavior fits your entry rules? That's how professionals fine-tune indicators. Not by memorizing arbitrary numbers, but by designing the settings around the market, not the chart. Let's say a trader is analyzing currency pair Eurotrade FX. They use MACD with standard settings. The pair is slow and steady. The MACD barely signals anything. Entries become late. Trend signals look flat. They switch to a shorter MACD setting. Suddenly, cleaner momentum, more consistent signals, better alignment with the pair's behavior. The indicator didn't improve. The settings matched the market. That's the power of customization. Let's finish with the most important lessons. Default settings are not designed for your strategy, they are generic templates. Market conditions change, settings must adapt. Volatile markets need smoother, slower settings. Ranging markets need faster sensitivity. Time frame drastically affects indicator behavior. Customization is the difference between random signals and reliable signals. If you understand this, you're already ahead of the majority of traders still using indicators the way they came out of the box. Your charts and your results will improve instantly.